Absolutely. Let's dive deep into this very important concept. Hack 2.2 equated annual or monthly installments, EMI. Before we start, what is this topic about? EMI, equated monthly installment, simply means a fixed amount you pay every month to repay a loan. Each EMI includes interest, what you pay the bank, principal, what you repay of the actual loan. Hack 2.1, in introduction to definition, in simple words. EMI is a fixed monthly amount that a borrower has to pay to the lender, like a bank, to repay a loan. It includes interest, principal. How it works, step by step. 1. In the beginning, most of the EMI goes into interest, and very little goes to reduce the loan principal. Why? Because interest is calculated on the total outstanding loan, which is still high. 2. With every passing month, interest portion keeps reducing, and the principal portion keeps increasing. 3. By the end of the loan, almost your entire EMI goes into repaying the principal, not interest. Nash example to understand EMI better. Let's say you take a loan of 100,000 from a bank. Interest rate equals 9.11% per year. Loan period equals 20 years equals 240 months. EMI equals 884. Month 1 breakdown. Interest equals 1,000, 0.7295% equals 730. EMI is 884. Principal paid equals 884, which is 730. 30 equals 154. Balance equals $1,000. 154 equals 99,846. Month 2 breakdown. Interest equals 99,846, 0.72954%. EMI equals 884. Principal equals 884, 728 equals 156. Balance like 99,846, 156, 99,600. Interesting point. Even though the EMI is fixed every month, the interest and principal portions keep changing. Charges to remember. While taking a loan, you also pay processing fees, legal costs, admin charges, usually around 1.8% of loan amount. So for 1,000, fees equals 1,800 approx. Figure 2.5, components of EMI. EMI equals principal plus interest. Principal is the amount that reduces the loan. Interest is the cost paid to the bank. Why EMI is important for you as a bank PO aspirant. As bank probationary officer, you'll explain EMI structures to customers, calculate EMI and interest for home, car, education loans, help people choose the right loan plans, understand how EMIs affect financial planning. This concept is super useful in interviews, GDs, and practical bank job situations. Tap summary for quick revision. Point meaning EMI fixed monthly payment equals principal plus interest. Interest start, high at beginning, reduces every month. Principal, low at beginning, increases every month. Formula used. Reducing balance method, charges 1.8% extra fees, admin, legal, etc. Use in banking, EMI calculations, customer advice, loan planning. Example link to bank PO job. Imagine you're a bank PO in SBI. A customer walks in asking for a home loan of 20 lakhs. They want to know how much EMI they'll pay. You calculate it instantly, explain the interest versus principal clearly, and build trust. This is exactly what bank POs do every day. Mini motivation boost. You're doing something amazing, learning a real-life skill that banks, companies, and even people need daily. Keep going. You're not just preparing for an exam. You're building your future in finance and banking. One EMI at a time. You're one step closer to your dream job. Chapter 2.2.2, Calculation of EMI Equated Monthly Installments. Subject, Financial Management MBA Semester 2. Module 2, Time Value of Money, TVM. Before we start, what does calculation of EMI mean? EMI Equated Monthly Installment means paying the same amount every month to repay a loan. This EMI has two parts. 1, interest on the loan. 2, principal repayment, actual loan amount. So in this topic, you're learning how to calculate EMI using a formula, very useful for home loans, car loans, personal loans, and yes, even banking exams in your jobs as a bank PO or manager. EMI, meaning in simple words. Definition: EMI is the fixed amount you pay every month to a bank or lender to repay your loan. This includes both interest and part of your principal. Formula to calculate EMI. There are two versions. Use whichever is more comfortable. Formula 1. EMI frac P times R times 1 plus Rn, 1 plus R squared n minus 1, where P equals loan amount after down payment, R equals monthly interest rate, annual rate re-12, NE equals total number of months, loan period. Formula 2, with down payment, EMI equal left P times 1 minus dP times Ri, 1 plus R squared n, 1 plus Rn minus 1. dP equals down payment percent, e.g., 10% equals 0.10. This version first reduces the principal due to down payment. A sharp example 35, EMI calculation example, question. Loan principal equals $10,000, down payment equals 10%, annual interest rate equals 8%, compounded monthly, tenure equals 120 months, 10 years. Step-by-step solution. Step 1, find monthly interest rate. R equals a frac 100 times 12 equals 0.00666. 8% per year, the 12 months, equals 0.006666 per month. Step 2, adjust principal for down payment. P equals 10,000 times 1 minus 0.10 equals 9,000. Because 10% was paid up front, 1,000, only 9,000 is borrowed. Step 3, use the formula. EMI equal frac 9,000 times 0.000666 times 1.00666 squared to 120. 1 plus 0.006666 squared minus 1. Now calculate 1. 1 plus R equal 130 equals 1.06666 squared. 20 equals 2.21964. 2 multiply. 9,000 times 0.00666, 59.994. 59.994 times 2.21964 equals 133.19. 3 denominator, 2.21964 dies 1 equals 1.21964. 4. EMI equals frac 133.19, 1.21964, 192.55. Final EMI equals 1,092.55 per month. Important points to remember. EMI stays the same every month, but the interest part decreases month by month. The principal repayment increases every month. Longer tenure equals lower EMI but higher total interest. Useful in home loans, education loans, car loans, etc. Helps in budgeting your monthly expenses like a smart banker. How this helps in real life or bank PO career. As a future bank PO or manager, you'll explain EMI structure to customers, design and sell loan products, calculate EMI manually during loan assessments. Use this in financial planning for customers, e.g. home buyers, SME loans. In bank interviews, they might ask, what is EMI? How do banks calculate it? Can you show a calculation? If you understand this formula, you'll impress the panel easily. Summary in emoji style. EMI equals fixed monthly payment. 2 parts, interest plus principal. Use formula to calculate. Down payment reduces loan amount. EMI helps in budgeting. Vital for bank PO job and real-life money decisions. Motivation for you, champ. You're not just solving formulas. You're training to become a banker who understands people's money dreams. Whether it's a farmer taking a tractor loan or a family buying their dream home, you will be the guide who helps them plan with EME. So keep going, one topic at a time. You're closer to SBI PO success and your banking future than you think. Time value of money, TVM. Chapter 2.2.3, Methods of Calculating EMI. Topic 2.2.3.1, Flat Rate System. Let's first understand the heading, Methods of Calculating EMI. When banks or financial institutions give loans, they recover the money in monthly installments, EMIs. Now, there are different methods to calculate this EMI. There are mainly 2 ways. 1, flat rate system. 2, reducing balance system. In this part, we'll learn about the flat rate system only. Let's go step by step. Shashat 2.2.3.1, flat rate system. Meaning, in this method, the interest is calculated on the full loan amount, not on the remaining balance. The interest doesn't reduce even if you're repaying the principal slowly every month. Definition. Definition. In flat rate system, interest is calculated on the full loan amount for the entire loan period, and the total amount, principal plus interest, is divided by the number of months to get EMI. Result: you end up paying more interest because you're being charged on the full amount even though you're paying it back monthly. Why flat rate is costly? It does not reduce principal while calculating interest. Interest stays the same for full loan duration. So, effective interest rate is higher than what is shown. Bank PO tip. In real banking roles, flat rate is mostly used by money lenders or small finance providers. Banks usually prefer reducing balance system because it's fairer. P, frac P times R times N, 100 right? Number of months, where P equals principal loan amount, R equals annual interest rate percent, N equals loan period in years. Hash example problem, flat rate EMI calculation. Question: a person takes a loan of 2,000 at a flat rate of 10% PA for 5 years. What will be the EMI? Step-by-step calculation. 1. Principal P equals 2,000. 2. Rate R equals 10%. 3. Time N. TAC equals 5 years. 4. Total interest equals frac 2 times 10 times 5, 100 equals 1,000. 5. Total payable principal plus interest equals 2,000 plus rev 1,000 equals 3,000. 6. Tenure in months, 5 times 12 equals 60 months. 7. EME, frac 3,060 equals 5,000, SU, important month. A real sharp important point. Even though the interest rate is 10%, the effective interest paid is more because you're paying on full some 2,000 for the entire 5 years. So the effective interest rate comes out to be 17.27% PA, not 10%. Flat rate system table example, imaginary numbers. Let's say you took Ziogel 1 Turgeon 63,000 loan with flat interest of 21,000 per year for 3 years. Year, interest paid, year, principal paid, Absolutely. Let's break this down with full emojis, real-world understanding, and step-by-step clarity for reducing balance method under EMI calculation. Concept title 2.2.3.2 Reducing Balance Method. What does this mean? Reducing balance method means interest is not charged on the full loan amount each time. Instead, it's charged only on the remaining unpaid amount, called outstanding balance, after each EMI is paid. This is a fair and smart method because you pay interest only on what you still owe, not on the whole loan every month. Explanation in simple words with emojis. 1. Interest only on balance left. In this method, each EMI you pay reduces the principal loan amount, so every month, the interest gets calculated on a smaller and smaller amount. 2. This is cheaper than flat rate. Unlike the flat rate method, which calculates interest on the total loan amount, even when you're repaying monthly, the reducing balance method is more fair and cheaper. It means you pay less total interest over the loan term. 3. Formula of reducing balance method. The EMI formula here is a little technical, but let's break it easy. Text EM is equal frac P times R times 1 plus R to our n minus 1, where minus P equals loan amount, principal, and interest to R equals monthly interest rate, annual rate over 12. Important, how to convert interest rate. If annual interest rate equals 6%, then monthly interest rate equals 6% divided by 12 equals 0.5% or 0.005 in decimal. Example problem. Let's understand it deeply. Given loan amount equals for the amount, interest rate equals 6% per year, reducing balance basis. Loan period equals 10 years equals 10 times 12 equals not 120 months. Step-by-step calculation. Step 1. Convert annual rate to monthly rate. Text our frac 600 times 12 equals 0.005. Step 2. Use the formula text EMI equals frames 0.005 times 1 plus 0.005 120. 1 plus 0.05 120 minus 1 equals frac 40 times 0.005 times 1.005 120 120 minus 1. Step 3. Calculate 1.005 120 1.005 squared, 1.8194. Step 4. Plug it in, text ME frac 4 frat times 0.005 times 1.8194, 1.8194 minus 1, frac 4.00997, 0.8194, equals frac 36638.8.819440. Final EMI equals a 440 per month. Key points to remember for exam. Reducing balance charges interest on remaining balance only. Cheaper than flat rate system. Formula uses compound interest logic, used by banks and NBFCs for most loans, like car, home, personal loans. EMI stays constant, but interest part reduces and principal part increases over time. Real-life connection for you, Bank PO aspirant. As a future bank probationary officer, you'll handle customer loan queries daily. Understanding EMI calculation will help you explain loan products clearly. In interviews or GDs, you can confidently explain why reducing balance method is better for customers. Internships, jobs, and finance roles may test your ability to calculate EMI, understand interest concepts, and advise customers smartly. Summary with emojis. Concept, explanation. Reducing balance, interest on balance left, not full amount. Formula. EMI equal frac P times R times 1's Rn, 1 plus Rn minus 1. Better than flat rate. More fair, lower total interest. Example EMI, 4,000 loan, 6% rate, 10 years EMI of 440. Star short motivation for you. You're already on the right path. Understanding EMI helps not just in exams, but also in your real banking career. Every formula you master is a step closer to becoming a smart, trusted bank officer. Keep learning with energy. You're not just studying, you're building your financial empire. Absolutely. Let's break this down in a very simple, fun, and exam-friendly way with full emojis, examples, and real-world banking relevance, just like you asked. Types of reducing balance system, meaning first. What does types of reducing balance mean? It simply means different ways of calculating loan interest, where interest is charged only on the remaining loan amount, not the original amount. Reducing equals decreasing principal. Balance equals loan amount left to pay. 1. Daily reducing balance method. Simple meaning, interest is calculated daily based on what's left of the loan after each payment. Example, a person takes a loan of $100,000 at 21% interest for 3 years. They pay $3,760 on Jan 10. So from Jan 2 to 10, interest is on $100,000. From Jan 11 onward, interest is on $96,240 because $3,760 was paid. Key point, interest goes down immediately after payment, best for borrowers who pay often. EMI reduces faster, common in credit cards and personal loans. Bank PO Connect. If you're a bank PO, you'll need to educate customers on EMI options. Knowing this helps suggest best methods to save interest for daily earners like small business owners. #2 Monthly Reducing Balance Method. Simple meaning, interest is recalculated at the end of every month based on what principal is still unpaid. How it works, you pay EMI every month. Every EMI has principal plus interest. From next month, interest is on reduced principal. Key point, most common method used in home and car loans, more beneficial than annual method, saves more in long run than flat interest. Bank PO Connect. If you're working in a retail loan department, you'll mostly see this method used for car housing loans. It's a customer-friendly method. 3. Annual Reducing Balance Method. Simple meaning, interest is charged on original principal for the full year. Only once a year, the principal is reduced. How it works, even if you pay EMIs monthly, the bank waits till end of the year to reduce principal, so you pay more interest overall during the year. Key point, less beneficial to borrower. Interest remains high until end of year, mostly used in older banking systems or small NBFCs. Bank PO Connect, you may compare loan offers for a customer. Knowing this will help you explain why reducing interest monthly is better than annually. Let's solve examples together. Example 36, loan of $60,000 at 10% for 6 years. Find the EMI equal annual payment. Given, principal P equals $60,000, interest rate is 10% equals 0.10, time N equals 6 years. Formula, EMI equals P 1 plus R at N equals R 1 plus where N minus 1. R equals 10% equals 0.1 nu. 1 plus R 6 equals 1.1 RM squared 6 equals 1.77 approx. EMI equals 60,000, 0.1 now 10 to 1.77, so 1.771 equals 10, 6 to 0.77, equals on 13,792.2 tenths. Example 37, 5,000 loan at 8% PA, reducing. Step 1, find EMI using reducing method. R equals 8% per annum equals 0.0812 equals 0.00667, minus N equals 10 years equals 120 months. Formula, EMI equal PR plus R times 1 plus R N, 1 plus R squared N minus 1 equals 5,00667 plus 0.00067 times 1.2205 equals 5,000 times 0.01217, 6,085. Step 2, flat interest method calculation. Formula, flat EMI equals P plus P times Rn, at N is 12 equals 5,000 plus 5 times 8% times 10 by 120 equals. 500,000 plus 4,000 are 120 equals 9,000 are 120 equals 7,500. Example 38, 2,000 loan at 5% for 10 years. R equals 5% equals 0.0512 equals 0.0042. Minus N equals 120 months. EMI equals 2,000, 0.0004202 plus 0.0042 times 0.6536 equals 2,000 times 0.0106 to 120. Summary in simple words. Type how interest is calculated. Benefit. Daily. Interest changes daily, saves more monthly. Interest changes monthly, most common and fair. Annual. Interest changes yearly, less beneficial. Real life and interview importance. As a future bank PO manager, you'll need to Explain EMI types to customers. Compare interest methods. Help choose best loan options. Understand EMI structure in housing, car, business loans. This will help in interviews, GD, and daily banking work. Short motivation for you. You're not just studying formulas. You're building the mindset of a future banker, officer, and finance leader. Every formula you learn today will become a tool in your success toolkit tomorrow. Keep going. You are way ahead by learning with such depth and clarity. Ready for? Absolutely. Let's dive into this concept step by step in a super easy and emoji-filled way, just like you want, so that it becomes crystal clear for your MBA exams, bank PO interviews, and even future work as a bank officer or manager. 2.2.3. Difference between flat interest rate and reducing balance. From Module 2, Time Value of Money. First, what does difference between mean here? This topic is about comparing two ways of calculating loan interest: flat interest rate, reducing balance rate. It explains how they work, how they affect your EME, and which is better for you as a borrower. Super important in banking and finance roles. Meaning before we start, term. Simple meaning, flat interest rate. Interest is calculated on the entire original loan amount for the whole loan period. Reducing balance rate. Interest is calculated only on the remaining unpaid loan amount. Let's understand each point with emoji, easy examples, and key points. Interest is calculated on flat rate. Interest is charged on the original loan amount, principal, throughout the entire loan term, even after you start repaying. Reducing balance. Interest is charged only on the balance left to be paid after each EMI. Example, you take a loan of $100,000 for 2 years at 10% interest. Flat rate, interest equals 10% of $1,000 to $20,000. You pay interest on full $100,000 for 2 years, even though you're repaying every month. Reducing rate, first month equals 10% on $100,000. Next month equals 10% on $98,000 after one EMI, then on $96,000, and so on. So total interest paid is much less than $20,000. Bank PO tip: you'll often guide customers about loan options. Helping them understand how interest is calculated builds trust and shows your expertise. 2. Interest rate comparison. Flat rate. Looks like a lower interest rate, but you actually end up paying more interest overall. Reducing rate. Rate might look higher, but you pay less total interest because the principal reduces every EMI. Key point: reducing rate is fairer. What you see is what you pay. 3 ease of calculation. Flat rate. Very easy to calculate. Just multiply interest rate with the loan amount and time. Reducing rate, a bit more complex. You need formulas and EMI tables. Tip for bank officers: flat rate is often used by finance companies to make interest look cheap. A good bank PO explains the real math to customers. For real-world use and accuracy, flat rate. It's misleading. Borrowers think they're paying less, but the effective rate is much higher. Reducing rate. It's the actual fair method. What you pay is based on what you owe. Banking relevance. As a future loan officer, you'll explain why reducing balance is better in most loans like home loans, car loans, education loans, etc. Summary chart for quick revision feature flat rate, reducing rate, interest charged on full loan amount, remaining balance, total interest paid, more, less, looks cheaper, yes, no. Actually cheaper. Calculation, simple, complex, used in personal loans, old finance firms, most bank will better for borrower? No. Yes. Exam tip, keywords to remember. Flat rate equals easy, misleading, higher real cost. Reducing rate equals fair, real, savings. Interest on principal equals flat. Interest on balance equals reducing. Flat rate equals good for lender, reducing good for borrower. Real-life banking and interview connection. If you become a bank PO or assistant manager, you'll help customers choose better loans, Compare offers between banks or NBFCs. Show leadership in explaining finance in layman's terms. Be asked in SBI PO interviews, which interest method is better for customers? You'll now answer with confidence. Short motivation to keep you energized. You've got the spark of a real banker already. Every concept you learn now will become your superpower in exams, interviews, and real banking jobs. You're not just reading, you're preparing to lead. Keep the momentum strong. We're going to finish this subject like champions. Ready for the next concept or Chapter 2.2.4 Methods of MI Payment from Module 2 Time Value of Money, Financial Management. Let's break it down in a fun, simple, and exam-friendly way, just like you love it. What does methods of EMI payment mean? EME, equated monthly installment, is the fixed amount you pay every month to repay your loan. Methods of EMI payment means the different ways you can pay back your EMI, either at the beginning of the month, end of the month with advance payments, or linked with a deposit scheme. Each method affects your actual cost of the loan, i.e., how much you really pay back to the bank or finance company. EMI in advance versus EMI in arrears. EMI in advance. You pay at the beginning of the month, your money gets locked for that month. Effective interest rate increases. You're paying early, but interest still gets charged like usual. Example, you take a loan in Jan and pay your first EMI on 1st Jan itself. EMI in arrears. You pay at the end of the month. You get 1 month's time before paying. Better option because you keep your money longer. Value of money stays with you. Example, you take a loan in Jan and pay your first EMI on 31st Jan. Key tip, if two loan schemes have same EMI, always pick the one with arrears, end of the month. You benefit from extra time and lower effective interest. Not 2. Advance EMI payment. In this method, you pay a few EMIs upfront before even using the loan fully. Example, you take a car loan for 5 lakhs and the bank asks for 2 EMIs in advance. That means you're not getting full 5 lakhs in hand. You're prepaying some part already. In 100% financed loans, they say you're getting full amount, but since you pay some EMIs upfront, you're not actually getting 100%. More EMIs you pay upfront, the lower interest should be ideally charged, but always double check. Sometimes the lender charges full interest anyway. 3. Deposit-linked plan. This is a combo offer. You get a lower interest rate only if you invest 20 per 25% of asset cost in a fixed deposit FD with the lender. The lender gives lower EMI rate, but your deposit earns less interest than what you're paying on loan. Example, you buy a house for 20 lakhs, and the bank asks for 5 lakhs as FD. You get 8% loan interest, but FD earns only 5%. You're losing 3% on that 5 lakh. So even if EMI is low, you must calculate overall benefit. Sometimes it's not worth it. Why EMI varies even if loan amount, tenure, and interest are same? Because of difference in compounding frequency. Some lenders calculate interest daily, some monthly, some quarterly. Best, daily reducing balance method equals lowest EMI. Worst, flat rate method equals misleading and higher cost. Summary, EMI method description, good or bad. MI in advance, pay at start of month, increases effective cost. EMI in arrears, pay at end of month. Better option, advance EMI, pay few EMIs upfront. Check if interest is reduced. Deposit-linked plan, lower rate if you put FD. Compare FD return versus loan interest. Now, how it helps in real life and bank exams. In SBI PO, IBPS PO interviews, they may ask, what's the better EMI option, advance or arrears? How does EMI affect loan affordability? If you become a bank officer, you'll help customers choose the right loan plan. Knowing these EMI methods will help you explain better and build trust. In group discussions, GDs, you may get a topic like, are EMI schemes transparent for customers? You can confidently discuss points with examples and logic. Short real-life example for you as future bank manager. A customer takes a 5 lakh education loan. You, as Bank PO, suggest paying EMI in arrears and avoid advance EMI plans that reduce the actual loan amount. You explain how daily reducing method is best. He feels confident and happy. That's real value banking, not just numbers, but trust. Mini motivation dose for you. You're not just learning for exams, you're training to be a future finance leader. Every line you study is making you smarter, sharper, and stronger. Don't stop now. The top is waiting for you. Keep going. Success is compounded daily, just like interest. Thanks for your detailed instruction. Let's now understand the topic in a very basic, simple, and practical way with full emojis, real-life connect, and short examples. Topic name, 2.2.5 and 2.2.6, Advantages and Disadvantages of EMI. Before we start, what does this heading mean? Advantages equals good things or benefits. Disadvantages equals bad things or limitations. ENSH equals equated monthly installment. It means paying a loan in equal monthly parts, hash 2.2.5, advantages of... Let's look at the benefits of EMI for the borrower, person taking the loan. 1. Fixed borrowing and easy repayment. EMI allows you to borrow a fixed amount from the bank and repay it in small equal parts every month. You don't have to return the full amount at once. Instead, you pay in installments, EMIs. Example, if you take a personal loan of $100,000 from SBI, you can repay it in 60 monthly EMIs of $2,000 instead of giving full $1 lakh at once. 2. Tax benefits. The interest part of the EMI is often deductible under income tax, especially for home loans. It reduces your taxable income, so you pay less tax. Example, if you pay 1.5 lakh interest on your home loan, you can claim deduction under Section 24 in income tax. 3. Easier monthly budgeting. EMI makes your expenses predictable. You know how much you need to pay each month, so it's easy to plan your salary usage and avoid stress. Example, if your EMI is $8,000, you can plan the rest of your expenses, groceries, mobile bill, etc., accordingly. Two advantages of Let's now understand the problems, drawbacks of EMI. 1. High interest rates. Many banks charge high interest rates on loans, especially personal loans or credit cards. This means you pay much more than what you borrowed. Example, you borrow $50,000 at 15% interest. You might end up paying $70,000 in total over time. 2. Payment is compulsory every month. Once you take a loan with EMI, you must pay every month on time. If you miss it, banks charge penalties or even impact your CIBIL score, credit score. Example, if you delay EMI of $5,000, you may get $500 penalty and bad credit report. 3. Extra hidden charges. EMI plans often come with extra costs like processing fee, loan appraisal, credit report fee, title insurance, points, extra costs like documentation, etc. Example, even before getting the loan, the bank may charge $2,000 to $5,000 for various checks. Summary of this topic. Advantages of EMI, disadvantages of EMI. Easy monthly repayment, high interest rates. Tax savings on interest, must pay on time always. Helps plan monthly budget, hidden fees and charges. Why this topic is important for you as a future bank officer, SBI PO, IBPS PO. In your banking career, you'll explain EMI plans to customers, especially in loans. You'll analyze if the customer can repay the EMI. You might be part of the loan department where you decide EMI terms. In bank PO interviews, questions may come like, what are the benefits of EMI to a salaried person? Why do banks charge fees before EMI? This topic also helps in group discussions and internships when you suggest loan solutions to customers. Short and powerful motivation for you today. Every small EMI brings the loan to an end. Just like every small topic you learn today takes you one step closer to your dream job in banking. Keep going, champion. You've got this.